Okay. Calculate the weighted average cost of capital from the following using two different approaches to calculate the weighting factors. All right. So we have a balance sheet extract for TBL PLC. Okay, we've got our ordinary shares. This is 20,000. So this company has got 20,000 shares. The par value or the face value or the nominal value of the shares is 50 ngwe. So when TBL PLC issued shares, the shares were going for 50 ngwe. Okay. So that is the nominal value. Just like 100 kwacha note, on that note, you see that 100, that's the face value or the par value or the nominal value of that note. It's the same thing with shares. Okay. So this was the money raised by selling shares, 10,000 kwacha. This is called the ordinary share capital. Okay. Now these shares on the securities exchange, they are trading for 1.72 ngwe. Okay, so basically what this is meaning is if you want to buy shares for this company, you're now paying 172. Okay. Next, we've got preference shares. Okay, even preference shares, as we see here, one quarter nominal value. This 9% is the dividend rate for the preference shares. Okay. Preference shares have got a fixed dividend rate, and as a preference shareholder, you're always entitled to dividends every year. Unlike an ordinary shareholder, some years you might not get paid dividends. Okay. But with preference shareholders, you have a fixed dividend rate, and you're entitled to dividends each year. So these preference shares, oh, this 5,000 kwacha was raised from selling preference shares. This is the preference share capital. So these preference shares, they're trading for 0.998 ngwe basically. Okay. So as you can see, per one kwacha. So this one kwacha is basically the nominal value or the par value or the face value. Okay. Yes. Then long-term liabilities, 10% debentures. So just the way a company can issue out shares, they can also issue out debt. Okay, this debt is also traded in the bonds market. Okay, yes. So this is the value of the debt, 7,500. This debt, okay, it's also got a face value. It's also traded in units like shares and preference shares. All right. So this is the face value, one kwacha. Okay. Then this is how much you're paying for the debentures on the stock market. Okay. One kwacha for ngwe. Okay. So this is the difference between preference shareholders, ordinary shareholders, and debt holders. The debt holders, them, they're entitled to interest payments. All right. So if you purchase one unit of the debentures, okay, each year you're going to be paid interest. Okay. Now, this debt and also preference shares, there's a sometimes they can have a maturity date. Okay. Other times they can be in perpetuity, meaning they do not mature. Okay, you just be getting interest payments or your dividends indefinitely. All right. So the questions tend to change depending on those circumstances. And when a company closes down, The first people to get paid are the debt holders. These are the first people to get paid. Then the preference shareholders. Then finally the ordinary shareholders. Okay. So preference shares is like a hybrid between ordinary shares and also debt. Okay. Why it's almost like debt? Because you're receiving interest fixed dividend payments. Those fixed dividend payments are similar to the fixed interest payments you get for a debt. Okay. Then with ordinary shares, because it's a dividend, so both of you are getting dividends basically. Okay. And ordinary shares, it's part ownership. Okay. So even with preference shares, you're also a part own. With debt, you're not an owner. Okay, you are not you don't own any part ownership in the company. But with preference shares and ordinary shares, you're part owned. So preference shares, you are a hybrid between the two. Okay, and as I said, preference shares, just like debt, has also got can also have a maturity date. Okay, or they can just be irredeemable, meaning there's no maturity date and just be receiving your payments as long as the company is still there. Okay, so told us the interest rate on government bonds is 7.5% and the expected market return is 20%. TBL PLC has an equity beta of 1.42 and corporation tax is 30%. So this information that they've given us here is going to help us tabulate the cost of equity using the capital asset pricing model. So when we reach that part, I'm going to explain this information. So the first thing that we need to do with this question, because the versus, we have to use both approaches to calculate the weighting factors. So the approaches that you can use is you can use the book values, basically these balance sheet values. You can weight them out, okay? Meaning you get them in proportions of the total amount, or you can use the market values, okay? So the market values represent the current and the present information, the present data. The book values are historical, present historical information. Okay, so usually it's preferred to use market values because that represents what is currently happening with the company. Okay, yes. So the first thing that you usually do with this type of questions, you can get you can weight these values, the book values and the market values. Okay, because the reason why I'm saying that is because, as you see, in the formula for the weighted average cost of capital, okay, let me just put it here. Let me just let me type it out. In the formula, you are going to be getting the weights of the ordinary shares and the preference shares, and you will be multiplying them by the individual costs. Okay, so let me put the formula like this: E plus D. Actually, let me use O. So O represents ordinary shares, P represents preference shares, D represents debt. So the weight of ordinary shares, that's why you see O over O plus P plus D. The weight of the ordinary shares, you multiply it with the cost of the ordinary shares, basically, the cost of equity, which is the cost of the ordinary shares, plus the weight of the preference shares. You are going to multiply it by the cost of the preference shares. Okay, these fractions that I'm putting here represents the weights. Okay, basically these weights also represent the capital structure of the business. Okay, they represent the capital structure. When we say capital structure, Just telling us how much equity financing are we using from ordinary shares and also from preference shares, and how much debt financing are we using from debt. Okay. Yes. So as you can see, this is the formula for work. Other books, they will show it as VE over VP plus VD like that. I want to show it in a simple format so that we get the concepts. Yeah. So here, these are the weightages. So I usually advise the first thing that you do with these type of questions is get the weightages first. So that the time you reach the formula here, you don't need to do these tabulations in these fractions. You'd have already got the weightages. Okay, colleagues? So yes. So let's get the book weights. Okay. So basically we just total up what's the total financing from these balance sheet values here. Those that is how we're going to get the weights. First we need to total up the to get the total financing and get the weighting for each source of financing: ordinary shares, preference shares, and the debt. Sorry, I was kicked out. The band was finished. Where was I kicked out from? What did you hear me say last? Did we hear about this part where I was emphasizing to get the weightings of ordinary shares, preference shares, and the debt? I just need to know where should I continue from. Mr. Mpasa, where was I kicked out from? Oh yeah, yes, because it represents the current data. So speaking on that, I said, as you can see, this is the formula for the weighted average cost of capital. O represents ordinary share capital, the money raised from selling ordinary shares. P represents preference share capital, the money raised from selling preference shares. D represents the value of the debentures, the money raised from selling these debentures. Okay, colleagues? Any questions? So, as I said, the first thing that you need to do is you need to get the weights of ordinary shares, preference shares, and debt. So that when you reach this formula here, when you've got the weightages, you just substitute, okay, so that you don't need to do these tabulations. Okay? So we're going to use first uh, the book values. We're going to use the weights of the book values. Okay, so we total up the total money raised from these sources of capital. Okay, so 10 plus 5, 15,000. 15 plus 7, that should be 15 plus 7, 5, that should be 22,500. Okay, so this is the total amount raised from the debt and the capital. Okay, 22,500. Okay, so now we want to get the weightages. We want to find out of this 22.5, what percent is from ordinary shares, what percent is from preference shares, and what percent is from the debentures. Okay, so let me put it like this here. So 10,000 divided by 22,000, what do we get? Okay, let's put here. Ordinary share capital. Yes, 10,000. So its weight 10,000 divided by 22.5, 0.44, which is 44% financing. So TBLC gets 44% financing. Then preference shares, it's 5,000 divided by 22.5, 0.22. 0, so 22% from preference shares. Then debentures, 7.5. 7.5 divided by 22.5, 0.33. So this is the capital structure of the TBL PLC. Okay, 44% financing is from ordinary shares, 22% is from preference shares, 33% is from debentures. Any questions? So these values that we've got here, the 0.44, we have highlighted, we put it as green. That's the weighting of ordinary shares. So where there's this green one here, you will replace it with 0.44. Here, let me put it as purple. So here, for preference shares, where you see P over O plus P plus D, that is the weighting for preference shares. In the debentures, I'll leave them as here, yes. Here where it's D over O plus P plus D, that's where you will substitute it with 0.33. Are we okay with this, colleagues? Madam Teresa, Madam Veronica, are we okay with this? Because remember, this is what's coming. So this is the time to ask. This is the time to ask. Madam Tandy, is that okay? And do you have any questions? Madam Veronica. Okay, you're behind on which explanation? We totaled, so this is how we got the weightages. We're using the book values, basically the balance sheet values. So what you do is you get the total amount raised from capital and versus debentures. Okay, so we added 10 plus 5 plus 7, 5. That's how we got 22, 5. Are we okay with that part, madam? Madam Tandu, are we okay with that part? Yeah. Then each source of financing, you are going to get its proportion out of this 22.5. So for ordinary shares, you do 10,000 divided by 22.5. That's how we got, basically, here's the table, yes. For ordinary shares, we did 10 divided by 22.5. For, that's how I got 0.44. For preference shares, we did 5 divided by 22.5. So I got 0.22. And for debentures, we did 7.5 divided by 22.5. That's how we got 0.33. Are we okay with that part? Madam Veronica, I haven't heard from you. Are we okay with that? Mr. Mpaz, are we okay with that? Yes, because this topic is it gets students confused and they don't understand it. So I'm trying to simplify it as much as I can and how you can tackle the questions. Okay. So that's how you get the weights using book values. Now, we also need to get the weights using the market values. Okay. So here, we need to get the total market value for ordinary shares, total market value for preference shares, total market value of debt. Okay. So basically, how we get the market value is it's just, for example, for ordinary shares, it's the number of ordinary shares times the market price. Because for preference shares, it's just the number of preference shares times the market price. For debentures, it's the number of debentures times the market price. Okay? Write down this formula because you won't be given. Debentures, number of debentures times market price. Have we written this down, colleagues? Have we all written this down? Have we all written it down, colleagues? Those formulae. Now, it's not always that they'll give you the number of ordinary shares, the number of preference shares, and the number of debentures. So the way you get the number of ordinary shares, it's the ordinary share capital, the money raised from ordinary share capital divided by the par value of the shares time. Okay, that's how you get the number of shares. Okay, ordinary share capital divided by the par value times the market price. Okay, similar with preference shares is the preference share capital divided by the par value or the nominal value or the book value of the preference shares times market price. Then debentures also the amount of debt divided by the par value times the market price. Okay. So these things, they are formula. You can see they're operating on a similar basis here in terms of getting. Yeah, yeah. It's the same concept for getting the number of these things: the number of ordinary shares, number of preference shares, and the amount of debt, number of debentures. Okay. So if we come to our question here, let me just bring this. Okay, so you can see ordinary shares. Okay, we've already been given the number of ordinary shares, but if we're not given the number of ordinary shares, okay, you would say, okay, your ordinary share capital is 10,000 divided by the par value. So it is say 10,000 divided by 0.5 kwacha, because 15 way, if you convert it into kwacha, 50 divided by 100, you get 0.5 kwacha. Okay. So 15 ngwe is like 0.5 kwacha. So if you do 10,000 divided by 0.5, what do you get? In your calculators, 10,000 divided by 20,000, what do you get? 20,000. Have you seen? You get 20,000 shares. Yes. So it's not always they'll give you the number of these things. So here, basically, these 20,000 shares times the market price. So you say 20,000 times 1.72. Mm-hmm. Yes, because you'll be dealing with kwacha. So, and if you're given something in Ngwe, you have to convert it into kwacha. So it's a must to always convert the Ngwe to kwacha by dividing 100. It's a must. Otherwise, you'll get inflated values. Because, for example, if we said 10,000 divided by 50, we would now get maybe, what's this? We might have got 10,000 divided by, we might have got like 200 shares, have you seen, which is a wrong thing. So, yes, madam, whenever you see anything in Ngwe, convert it to kwacha. Okay, now the next part. The So yeah, we said what's the market value of ordinary shares? So we say 20,000. 20,000 number of shares times the market price times 1.72, we get 34,400. Preference shares. You haven't been given the number of preference shares. So preference share capital 5,000 divided by the par value, which is one kwacha. So 5,000 divided by one kwacha, that is 5,000. It means this company TBLC has got 5,000 preference shares. Okay. Oh, preference share capital divided by this par value one quarter, that's how we get the 5,000 preference shares. So these 5,000 preference shares times the market value of 0.98 for each preference share. Okay, so 0.98 times 5,000, we get 4,900. Okay, and that's the preference share capital. Okay, then debentures. Also, then we need to know, okay, how many debentures does this company have? So the amount, this 7,500 divided by the par value, one kwacha. So it means TBL PLC has got 7,500 debentures. 7,500 times 1.04, we get, what do we get? 7,500 times 1.04. 7,800. So just like we did for book values, you get the total 34,400 plus 49 plus 7,800. What do we get? That's 7,100. Yes. So let's see if we've tested that, we've understood. So, colleagues, what's the weightage for ordinary shares? Okay. Madam Tandiwe, what's for preference shares? Are you there, Madam Tandiwe? What's the weightage for preference shares? Okay, what do we need to do to get the weightage? Then someone else can need it calculate it. What do we need to do to get the weightage? Correct. Okay, so can somebody give me that value? 0.104. Then Madam Veronica for debentures. Are you there, Madam Veronica? Is Madam Veronica there? Okay, Mr. Mpasa. Yes, Madam. What's the weightage for debentures? Okay. We can round it off to 0.166. That is correct. Yes. So, colleagues, any questions so far? Any questions so far? These are the same here. This one kwacha is the same one here. This per one kwacha just means per preference share basic. Okay. Okay, now we start with calculating the costs. Okay, so after you've got the weightages, now it's time to get the costs. Cost of equity, cost of preference shares, cost of debt. Okay. Now, what technique we use is dependent on the information given. That's all, Dr. Hicks. Okay, so we can start with first getting the cost of equity. So as I said, how you calculate is dependent on the information given in the question. Okay, so cost of equity, there are two methods to get it. Okay, there's the capital asset pricing model, and there's the dividend valuation growth model. Okay, so here, as I said, this information here, areas, as I said in the question, this information is for calculating cost of equity. The capital asset pricing model, what it's just telling us in simple terms is that the higher the risk which you're going to incur whenever you're investing in any of these securities, the higher the return. That's what it's telling us. The higher the risk, the higher the return. Okay, so this is the formula for capital asset pricing model. KE equals RF plus BE equity beta RM minus RF. RF represents the risk-free rate. So government securities, okay, like treasury bills, treasury bonds, and treasury notes, they are risk-free. Why? Because government, in the event that they've got no money to pay you, they can print out money and pay you. Theoretically, okay, government can just print money to pay you. Theoretically, so that's why it's risk-free. So since it's risk-free, you expect low returns, right, colleagues? Since the risk is there's no risk at all, so you should expect low returns. Don't expect to get rich because if you want high returns, you have to go for riskier securities. BE represents equity beta. Equity beta just measures the risk of shares, all right? The riskiness of shares, all right, with in reference to the stock market. Okay. So the equity beta of the stock market is 1. Okay. This is the threshold. Okay. Anything above 1 is a risk. Okay. Any security with an equity beta above 1, it's a risky security. Okay. There's a possibility that company you invest in, you might make a loss, you might lose your money. But In the event that company invests, makes a profit, then you expect also to get high returns. Okay. If the equity beta is below one, these are less risk. Okay. So also with these ones, do not expect high returns. Okay. So the equity beta for this company is 1.42. So shares for this company are risky, meaning if you invest, the company might make a loss and you might lose your money. Okay. Or they might make a profit and you can get your money back. Okay. In terms of dividends and returns. This expected market return, this is the average return you expect if you invest in that stock market. Okay, for example, if TBL PLC is in the Lusaka Securities Exchange, okay, there are also other companies in the Lusaka Securities Exchange. So, on average, if you invest in any of those companies, expect a 20% return. Okay, that's what the expected market return is, just like the average market return. Okay, so you can say, okay, for in this context, if TBL PLC is in the Lusaka Securities Exchange, so the average return in the Lusaka Securities Exchange is 20%. Any questions, colleagues? So it's just a matter of substitution here. Okay, so 7.5% plus 1.42. So 20 minus 7.5, you get 12.5. Okay. So 12.5 times 1.42. So I'm just putting this on the side to show you that as equity beta increases, you see that also the return will increase. But let's focus on this one first here. 1.42 times 12.5. My calculator is telling me, let's see, 17.75. If you want, you can convert these percentages into decimals, and then at the end, you have to convert it back into a percentage again. So you're better off leaving it as a percentage. So 75 plus 17.75 is 25.25%. Okay. So that is the return that is going to make the providers of equity financing happy. Now, as I said, with the capital asset pricing model, the higher the return, the higher the risk, the higher the return. So if we increase our equity beta to 2, okay, let's see what return we expect. So 7.5 plus 2 times 12.5. 2 times 12.5, that gives us 25. 7.5 plus 25, 32.5%. You see? So as the risk increases, basically this equity beta, the higher the equity beta, the higher the risk, basically, the higher the returns that you're going to expect. Any questions? Okay, for preference shares, this I've now here in this first part of the question, they haven't given us a maturity date for the preference shares and the debentures, meaning both of them are irredeemable. Meaning once you purchase any of them, you will just be receiving your payments as long as the company stays alive. You'll just be receiving either your dividends or your interest payments. Okay. So if preference shares are irredeemable, where they haven't mentioned any maturity date, it's just the dividend for the preference share divided by the market price. Okay. How we get the dividend for the preference shares is the dividend rate times the par value or the nominal value or the book value. So in our question, the dividend rate is given to us here, 9%. 9% of one kwacha divided by the market price 0.98. So 9% of one kwacha is 0.09. Basically, it's 9 in way. Okay, so 0.9 divided by 0.98, what do we get? 0.198, right? Not 0.01918. 0.0918. Then if you multiply it by 100 to convert it into a percentage, it becomes 9.18%. Okay, so this is the return, the minimum return that can make preference shareholders happy, 9.18%. Okay, these costs are just the returns that will make these people happy. Okay, so cost of equity, this is the return that the minimum return that will make ordinary shareholders happy. This 9.18%, this is the minimum return that will make preference shareholders happy. Okay. Then the debt now, cost of debt. Okay. So the cost of debt basically is the after tax interest rate yeah, the after tax interest rate divided by the market price. Okay, so I'll get the after tax interest rate is our interest rate, open brackets, 1 minus the tax rate divided by the market price. So this 1 minus t, okay, this 1 minus t It, what it's basically telling us is that whenever a company takes on a debt, okay, it lowers the interest that it must, I mean, it lowers the tax that it has to pay to the government. Okay, let me illustrate this. Okay, so since the tax is lowered, it's like it's a tax saving for the company. Okay, so let me just illustrate this. So here, company A, company B, this they make a revenue, both make a revenue of 1,000 each. Okay, after you deduct, let's say both in car costs of 300 kwacha each. So company A's profit uh, before tax basically is 700. Company B's profit before tax is also 700. Okay, so let's say since let's say tax is at a rate of 30%. Okay, what is 30% of 700? Well, let's make life easy. 10% so that I can calculate. Let's say tax is at a rate of 10%. 10% of 700 is 70. So the overall profit 700 times 70 minus 70, that's 630 kwacha. Okay, 630 kwacha. Now let's take company B. Let's say they've got interest payments of 100 kwacha. They've taken on debt. Okay, and then for the debt, they have to pay interest of let's say 100 kwacha. So 700 minus 100, that is 600 kwacha. Okay, then tax now. Tax is also at 10%. Okay, so 10% of 600 is 60 kwacha. So notice, company A never took on debt. They've got, um, so they paid tax of 70 kwacha. Company B takes on debt and is paying tax of 60 kwacha. So these interest payments, they lower the amount of tax that you have to give to the government. So in short, company B has saved the 10 kwacha from tax because they've paid 60 kwacha. Company A, since company A paid 70, company B paid 60. So it's like company B has saved a 10 kwacha. Okay. The profit might be lower, 600 minus 60, we'll get 540. Okay, you can say that profit is lower, but obviously this company that has taken on the debt, probably they bought, use the debt obviously to buy new machinery so that they can do their work faster. And that if they can do their work faster, it means they'll become more profitable than company B. Let's say these two companies are in the same industry. Okay. So company B probably has got better machinery now. It took on debt, it's got better machinery, so maybe it's even is able to produce now more than company A. So eventually you find in the later years, you find company B will now start making more profit. Okay. So that's this 1 minus T. Okay. It's just telling us that when you take on debt, you pay a lower tax. And since you pay lower tax, that's it's like a tax saving. Okay. So here, interest rate is 10%. 1 minus. The tax rate is 30%. Convert it into a decimal, 0.3. Even now, 10%, we can convert it into a decimal. Okay. Or you can leave it as it is. Market price of debt is 1.04. So 10% multiplied by 1 minus 0.3, that is 0.7. Divided by 1.04. Okay, 0.7 times 10, that is 7%. So that's the after tax interest rate. Okay. It's like you've saved a 3% basically. Divided by 1.04. 7 divided by 1.04, what do we get? 6.73%. So that is the cost of debt. So this is the return, the minimum return that will make the debenture holders happy. Any questions? Now, as I said, even this 7% you can convert it into a decimal. You get, when you divide, you get 0.0673. And that decimal you need to convert it back into a percentage. So to make life easy and to save time in the exam, we just leave the percentage as it is. Yes. So now we can now get our weighted average cost of capital. We've got our weights for book values and market values, and we've got our costs. Okay. So we get the weighted average cost of capital using the book values first. Okay. Because we want to find on average what is the return, what to make these providers of capital happy. What is the average return that will make these providers of capital happy? Okay. So if we use book weightages, for equity it was 0.44. Our cost of equity, what we calculated, was 25.25%. For preference shares, our weight is 0.22. Cost of preference shares, 9.18%, plus for debt, our weightage is 0.33. So now here, do not do this 1 minus t again. Okay. This is just telling you the after. This is just saying you after cost, after tax cost of debt. Okay. After tax cost of debt. Okay. Which is 6.73. So 0.44 times 22.5, what do we get? 11. That's the overall. Oh, 11.11. Okay. Then for preference shares, 0.22 times 9.18. Okay. We'll round it to 2.019. So we can round it up to 2.02% plus 0.33 times 673. Excuse me. 0.22%. When we add all of them, 11.11 plus 2.02 plus 2.22. Yes. So this is the minimum return that will make all the providers of capital happy. Okay. Or this is the overall cost of capital or cost of financing for the business. 15.35%. Okay. And then with market values, we can get our weighted average cost of capital. So for ordinary shares, 0.73. For preference shares, we're just changing the weightages, okay, but everything else will stay the same. Just the weightage just changed. Preference shares, 0.014, debt, 0.0116. Let's get our new values. So 0.73 times 25.25. Okay, preference shares, 0.104 times 9.18. 0.166 times 6.73. 1.17. Okay, so 18.43 plus 0.95 plus 1.17. Okay, we total up. 20.5%. Okay. So currently, this is the minimum return that the providers, or that make the providers of capital happy. Okay. Historically, using book values, because I said book values is based on history, on the past. So historically, this was the minimum return that will make the providers of capital happy. But now, currently, this is the new minimum return that will make the providers of capital happy. Any questions?